Welcome to the Explainer. Today, we're going to do something different. We're going to completely flip our thinking. We're going to stop acting like the gambler who walks into a casino, fingers crossed, hoping to hit the jackpot. Instead, we're going to start thinking like the casino itself. The house, the institution that is mathematically built to win over the long haul. This is not about luck. It's not about hot tips. It's about shifting from hoping for a miracle to building a system.
Okay, let's get right into the heart of it. The way most people approach options feels a lot like buying lottery tickets, right? They buy these cheap, way out-of-the-money options that need some massive, completely unpredictable move just to pay off. We're going to take that whole model and turn it upside down. Instead of paying for that long-shot possibility, we're going to be the ones selling it. We're going to be the ones selling that hope and collecting the payment for it. That payment is called a premium.
And this slide just lays it all out, right? On one side, you've got the gambler, and they're in a constant battle. They're fighting against time itself, which is literally eating away at the value of their position every single day. They have to be right about everything, which way the stock's going to go, when it's going to go, and by how much. But the casino isn't betting. The casino is just running a business based on cold, hard math. It uses the passing of time as a profit center, and it doesn't need a crystal ball to predict the future. It just needs the probabilities to play out over thousands and thousands of trades. All right, so here's the game plan for how we're going to build our casino from the ground up. First, we'll define the game we're actually playing. Then, and this is crucial, we'll learn how to set the odds in our favor by pricing risk correctly. After that, we'll dig into our most reliable source of profit, one that works 24/7. Then we'll learn how to manage the floor so we're not just betting on one outcome. And then we get to the really important part, confronting the biggest risks and figuring out how to survive them. And finally, we'll lock in the house rules for long-term success. Okay, section 1. Let's get really clear on what we're talking about here. When we say acting like the casino, what we're really talking about is selling insurance in the financial markets. It's a simple transaction, but it has two sides, and we want to make sure we're on the side that has the built-in mathematical edge. So what does that actually look like? Let's make it real. Imagine a stock, let's call it ABC, and it's trading at $100 a share. Now, another trader out there is terrified it might crash. They want protection. So you step in, you act as the casino, and you sell them a contract, a put option, that says, I'll protect you if the stock drops below $90 in the next 30 days. And for providing this service, you immediately get paid, let's say $150 in cash. That's the premium. You've just sold an insurance policy. Now, if that stock just stays above 90 for the next month, that contract expires worthless. And you just keep the cash. You got paid for taking on risk that never even happened. So, if we're the casino selling this insurance, how in the world do we price it? This is maybe the most important question. A real-world casino knows the exact odds of every single card in the deck. For us, in the market, our equivalent is understanding and measuring fear. Because fear is what makes insurance really, really expensive. The magic ingredient here is something called implied volatility, or IV. You can just think of it as the market's anxiety level for a stock. It's not about what the stock has done, it's what everyone thinks it's about to do. You've heard of the VIX, right? The market's fear gauge? That's just the IV for the S&P 500. When fear is high, say right before a big earnings announcement or an FDA decision, IV spikes. It's just like hurricane insurance. The rates go through the roof the day before a storm is supposed to hit. And that is exactly when we, as the casino, want to be selling policies. But hold on a second. You might be thinking, what's high? A 30% IV might be crazy high for a boring old utility stock, but dangerously low for a super volatile biotech company. The number by itself doesn't tell you the whole story. We need a way to figure out if the price of insurance right now is expensive for this specific stock compared to its own history. And lucky for us, there's a tool for that.
And this is our secret weapon, IV rank. It cuts through all the noise by asking one simple question. On a scale from 0 to 100, where is today's fear level compared to the highest and lowest it's been all year? So if the IV rank is 100, that means fear is at a 52-week high. It's so powerful because it gives us context. It tells us if we're selling that insurance at the absolute peak of the fear market or down in the bargain basement.
So this boils down to a really simple rule of thumb for us. We only want to be in the insurance business when the policies are overpriced. Generally, that means we look for an IV rank above 50. Why? Well, it's because of a powerful force called mean reversion. Volatility moves in cycles. Big spikes in fear are almost always followed by periods of calm. So by selling when IV rank is high, we're not just getting paid a ton of premium, we're also making a bet that things will eventually go back to normal. We can profit from the premium we collected and from the fear itself coming down. It's a beautiful 1-2 punch.
Okay, let's talk about the casino's most reliable employee. This one works 24 hours a day, 7 days a week. Weekends, holidays, never calls in sick, never asks for a raise. I'm talking about time itself.
You know the saying, time is money? Well, in the world of options, that is literally true. And its name is theta. Theta represents the daily decay of an option's value. Think of the option premium you sold as a melting ice cube. Every single day, a little piece of it just melts away. Now, if you're the person who bought that option, that's your money just vanishing into thin air. But if you're the one who sold it, that melted value drips directly into your pocket as profit. If an option has a theta of, say, -5 cents, it's scheduled to lose 5 cents of value today, just because the sun came up.
And here's the thing, it doesn't just melt at a steady pace. Look at this. It's not a straight line. An option with 6 months left to live might only lose a tiny bit each day. But once you get into that final month, that final 45 days or so, the decay curve turns into a cliff. The value just starts to collapse. And this is exactly why so many systematic sellers focus on that 30 to 45-day window. They are positioning themselves at the steepest part of the slope to get paid the most every single day from time's unstoppable forward march.
So, let's be super clear about this. As a seller, this accelerating decay is the engine of our entire strategy. We are literally getting paid to just wait. While the person who bought the option from us needs something big and crazy to happen, our absolute best case scenario is for nothing to happen at all. We just want the world to be boring, so this powerful force can just grind that premium down to zero and turn it into our profit. You know, a well-run casino doesn't really care if the player at the blackjack table wins or loses one hand. It doesn't bet on red or black. It makes its money from the sheer volume of play over millions of hands. It stays neutral. We can do the exact same thing with our portfolio. Now, delta is our measure of directional risk, and it's fascinating because it really does two jobs. First, yeah, it tells us how much money we'll make or lose if the stock moves by $1. But second, and for our casino, this is way more important, it's like a real-time probability calculator. An option with a delta of 0.30 has roughly a 30% chance of expiring in the money. That right there is a huge piece of the puzzle for us.
So the pro move here, the way the house really plays, is to become delta neutral. So for instance, if we sell a call option with a delta of +30, we could at the same time sell a put option with a delta of -30. And what's our total delta? 0. This is a complete game changer. It means we've effectively taken the stressful question, which way is the stock going to go, completely off the table. Our profits no longer depend on us being fortune tellers. They depend on time passing and on fear going down, two things that are way, way more predictable.
Okay, we've talked about the casino's edge, we've talked about high probabilities, and consistent income. It all sounds pretty good, but now we have to face the brutal truth. We have to confront the single biggest risk of this whole strategy, a risk that's often called picking up pennies in front of a steamroller. And I'm not kidding, this is the most important section of this entire explainer. This quote is everything. See, probability is just how often do I win, but expectation is how much do I win on average over the long run. You can have a strategy that wins 95% of the time. You can win and win and win collecting those small premium checks. But if that one loss, that 5% chance, is so massive that it wipes out all your previous gains and then some, you actually have a losing strategy. It's a losing strategy that feels like a winner, right up until the day it completely blows you up. This turkey analogy just captures the danger perfectly. Imagine you're a turkey. Day one, a human shows up and gives you food. For 1,000 days, every single day, you're fed, you're protected. All the data you collect confirms your model of reality. Humans are nice, and life is good. Your confidence in this model hits an all-time high on day 1,000, which happens to be the day before Thanksgiving. And then a single, unexpected event, a black swan, proves your entire model was catastrophically wrong. The risk wasn't just something you missed. It was totally outside of what you thought was possible. So this leads us to the most important risk management lesson there is. It's the core difference between how an amateur thinks and how a professional thinks, and it all comes down to understanding two different games that on the surface look almost identical. In Game A, the risk is spread out across a whole group of people. It's an insurable business. No single person faces a catastrophic outcome. That's called ensemble probability. But in Game B, In Game B, your personal path through time matters. You might be statistically favored to make money over the long run, but you cannot survive that one catastrophic loss. The average return doesn't mean a thing to you if you hit the bullet on the very first try. You're just erased from the game. Selling options without managing your risk like a hawk is playing Game B.
So let's tie all this together. What are the core, non-negotiable rules for running our casino successfully? And, most importantly, how do we make absolutely sure we are always playing Game A and never, ever, ever playing Game B?
And here it is, the whole system on one slide. These are the house rules. Rule 1, we only play when the odds are overwhelmingly in our favor. Rule 2, we let our best employee, Theta, do all the heavy lifting. Rule 3, we avoid trying to be heroes and predict the future by managing our delta. Rule 4, we are constantly asking ourselves, do I have a high probability of a small win or a real positive expectation? And Rule 5, the cardinal rule that trumps all others, survival. We protect our capital at all costs so that we can always be there to play the next hand.
So as we wrap this up, I'll leave you with this question. Now, the casino mindset isn't about just picking one right answer here. A gambler looks at that 200% and gets excited. A casino does the math. The expected value of the first trade is a 9% gain. The expected value of the second is a 20% gain. But the casino also asks about the risks, the variance, the chance of ruin. The real answer isn't about which one is better on paper. It's about knowing the math, understanding the risks of both, and then building a system around the game that you are built to play, day in and day out for the long haul. That is how you become the casino.